Good evening, friends. Today, ANMI WR is organizing a 73rd Knowledge Series webinar in association with PwC. I have chosen today's topic, which is relevant, and all of us are eagerly waiting to listen to tax expert on the subject. That is a Union Budget 2022. Insight on impact with respect to capital market. As you are aware, Budget 2022 for equity market is merely a story without any take-home. Finance Minister has not announced benefit to capital market rewarding our contribution to the economic growth, like scrapping of LTCG tax on equities, reduction of STT, or cutting dividend tax. However, the budget did contain some important measures which could have a long-range beneficial impact on the markets. To elaborate in detail, we have with us tax expert from PwC. It is a pleasant feeling to be present at this event and welcome dignitaries who kindly consented to be our panel speaker and moderate on the topic. I welcome Mr. Vikram Bohra, Partner PwC, and Mr. Jignesh Desai, Associate Partner PwC, who have kindly consented to my invitation to deliver a talk on the subject. I now request Mr. Jignesh Desai to moderate the session by sharing his initial view on the topic. Over to Jignesh.
Sure, sir. Thank you. Thank you very much. Vikram, you want to start and then I'll take it over?
Sure. Okay. Good evening, everyone. Welcome to the session and thank you, ANMI, for inviting us. It's our pleasure and really humbled and obliged to be presenting our view to this well-educated and well-understanding audience on the subject. What we intend to do, firstly, as you all know, that on the tax and the policy front, while there are a lot of announcements, but really if you look at the, say, tax front or the finance bill, there is not much announced or much done in the finance bill. I look at it in two perspectives, one a good one and a not so good one. The good one perspectives, and I always keep on thinking, though I've not yet shared this internally in my organization, is that this is budget has to become a non-event. Let's put that way. Budget has to become a non-event. You have to announce policies all across the year, every time whenever need is felt, and again the tax cannot be changing every year. You have to have certainty around taxes. You have to have a certainty around what the laws and provisions are. Now, to achieve that certainty, that's why we think about launching a new direct tax code, saying that it is the old act is 1961 Act and it has got amended like several thousand times. But who amends it? Why do we amend it? Therefore, in that context, if I look at this very matured, we are moving to a state of matured economy, saying that okay, we don't need amendments to the tax laws every year. We will do some tweaks here and there depending on the situations what has happened. But by and large, we are giving a certain and stable tax regime. That's very good, positive side of it. The not so good side of it, and I don't generally like that. I don't believe to that school of thought. I heard somebody saying that, and that's why I'm making that statement. Is that are our viewpoints listened? As Mahesh started the conversation, that look, the capital market had a lot of exemptions on reducing LTCG rates or reducing STTs, reducing dividend rates, and it has not done anything on that. So is somebody listening our voice? I believe to the first time that yes, government is listening. They don't find a need right now. As and when if we think the need, they'll hopefully do it. That's the way I look at this announcements. Now in this backdrop, what we've done is, for another 5 minutes or 7 minutes, what I'll do is I'll take you through large policy announcements. Now, over the last 2 days, you would have read all of the newspapers are filled with policy announcements, experts' views, and you would have learned about a lot of those things. Some of them, what I'm going to say is maybe repeating, but for sake of completeness, let's put it, because if the market is growing, if the indices are growing, right, increasing, what's the rationale? What's happening on that? So in that context, I'm presenting some key budget announcements. The first big thing is the thrust on the infrastructure, and more so infrastructure. Like you would have read multiple times this statement. It's a capital expenditure focused budget. The outlay of capital expenditure is like 35% increase. And where does the capital expenditure result into? Largely is infrastructure boost. So it is a huge capex is being used towards infrastructure for export promotion, for telecom, and for urban deployment. I like particularly the two things within this. The means infrastructure, I say okay, it's the same thing because yes, you have to do it, but very important aspect. And then I go back to that old statement: is government listening? One of the big things where we I think it is listening because of the announcements to have 4 multimodal logistics park. If you look at the supply chain in India, the big cost of the supply chain, why it is high, it's not about manufacturing cost not being competitive. It's not about power. It's not about labor, but it's about enabling the goods to reach to the ultimate consumer or to the port. And the logistics cost is higher in India compared to our peer or domestic other countries which are competing with us on supply chain, be it Indonesia, Vietnam, China, whichever countries they are. There are there are plans for launching 4 multimodal logistics park. That's a big thing. That's why I said I think they listen and they're saying, okay, we want to bring the logistics cost down. What should we do it? The second is the telecom. We heard about a lot on spectrum, 5G, everything. But somewhere I also read that they are going to come out with a PLI scheme, or they have already come out with the 5G gear. That's again a good development on the because it's not only at the telecom level, right? It's going below the telecom level. It's going to the producers and manufacturers, and the entire supply chain hopefully will change, improve on that. And the third important development I think is around urban development, right? He mentioned about the quality of living more than anything on the living on just urban development. He spoke about the quality of living, and he said, look, we will work towards urban development, modernization. We'll there has to be studies done to either what should be the modernization game plan, roadmap, how should the bylaws change, how should the town planning schemes should be launched out. And that's where you need a capex. So if this capex is actually well used based on what it is announced and planned, I think so it will be a good multiplier effect on what has been announced and such. Then there are other things which is like the same mentioned about MSME, agriculture, skill development, affordable housing, and I'm not touching upon each of those. The only one thing which I would like to focus is the most impacted sector, which is agri sector. Sorry, the travel and hospitality sector. They get an increased guarantee cover of 500 billion or 50 crores, I must say, and the extended credit line of guarantee scheme has been extended. So this is like positive for MSME, 1 year extension of the credit guarantee line. But other things, right? Look at the ease of development, ease of doing business in India. Now they said that we are going to come out with ease of doing business 2.0, right? That's a new version that EODB is going to benchmark to come. To make that work, right? The earlier EODB was all focused from what are the World Bank standards and just how do we fit within that World Bank parameters. Of course, and only relating to 2 cities, Mumbai and Delhi, and I think so they added one more city. So that was a limited thing on EODB. What they're now saying is we will have your own benchmarks on EODB, but where else, right? For making sure that EODB works, we are going to we are going to measure or benchmark states on leveraging digitization, right? E-passports, digital rupee, drone safety. They will mention a lot of those digital buzzwords, I would say. Land records management, big thing, right? Blockchain, so adoption of technology and blockchain, land records management to be automated. Faster exits, faster liquidations. It's a painful thing to say that, look, in India, to set up a company now it takes 15 days, but to make a company, bury a company, or when a company dies, to get the company liquidated takes maybe 2 years or more than 2 years. It is now being proposed to get it down to 6 months, which is a good announcement because a lot of companies are not used. What do? I cannot liquidate it because I cannot just go through the process. Those are things, and over last few years you would have seen a lot of investments which are coming to the country is not necessarily strategic, but it's the financial sponsors like private equity, large pension funds who are putting money into it. They have their own set of concerns and struggles to it, and the government has been openly asking them, okay, we will form a working. I don't want to amend, rush, bring budget amendments, the tax law amendments in rush, and just and again go back and forth on that. But rather, the government is saying that okay, we will set up a holistic working group and expert committee to look at all the regulatory and other hurdles that this industry is facing, and want to ensure that this industry scales up, both from investors in India and for investors globally. I think that said, there are few policy announcements which are big ones, right? Which hopefully are actually, I think so, um, really needed. One is on SEZ replacement. So what they are going to do is government is going to replace the SEZ law with a new law. Two big areas that they have to focus upon it. One, you would have read in the newspapers today, the SEZ law will focus on services industry. Uh, and so today the SEZ law was, it today also focuses upon it. But the thought process is all about manufacturing. So SEZ will now have to look at services and manufacturing both. And second is the SEZ law will also allow domestic sales. Given that unlikelihood of SEZ law to give any tax incentives, because that's not the way they want to have the SEZ law. They want to have SEZs to allow ease of doing business, but without tax incentives. In that context, if you look at it, they will allow the same SEZ unit to be used not only for exports but also for domestic sales and domestic businesses. The second thing is the International Arbitration Center in GIFT City. We are seeing, you would have heard for last 3-4 years, a lot of players going into GIFT City, setting up offices in GIFT City, international investors' interest coming to the GIFT City. But yet everybody is more concerned about, hey, listen, how do I tackle the judiciary? How do I handle the Indian judicial system? It's complex. It's time consuming. How do I don't want to take those risks. And they do insist upon arbitration. Again, in arbitration, if it was have a seat in Mumbai or anywhere else, again, it's subject to the Arbitration Conciliation Act 1996. But then they're saying, okay, we want to have GIFT City, all the matters in GIFT City, let's just handle the arbitration in GIFT City. Going to the lines of Singapore, but that's the way they want to have it. The third thing, they very, very interesting announcement. I never expected that was the world-class foreign. GIFT City was always meant for financial services, right? Or IFSC. Let me not use the word GIFT City, but IFSC was meant for financial services. They are allowing world-class foreign universities to be set up in IFSC. Now, I kept on thinking why, but then it's also they are getting the fresh talent right from the college and the schools coming into the business world, and that's a house of talent that you're getting by pushing educational institutions to come into the GIFT City. So that's the very important and good development in the long-term basis. And I'm not touching upon that global capital for sustainable climate, because that's fine. That's not a big in a sense. I don't think that's immediately needed for discussion of this. Now that brings me to the tax policy announcements. So these were like macro policy announcements, but there are some tax policy announcements, and then I will touch upon this a couple of few of them, and then the details will be my colleague Jignesh will take you on the details. But very broadly, as I said, we are moving to a certainty regime. Now, whether we like it or not is another area, but we are going to a more certain regime, and which means there is no significant change in tax rates. Tax rates are stable, they are same. Yes, everybody is complaining that we all expected some reduction in our slab rates, individual benefits, some reductions under ATCC. Nothing has come through, but that's keep aside. But the positive way of looking at it is there is a stability. Nothing changes on the tax rates. The second big thing which I liked it is about reasonable projections of tax collections. Every time, when till last year when we see the budgets, right? I see a common commentary when I hear the commentaries on the news channels and read the newspapers, that is the finance minister more aggressive or more beyond on its projections for tax collections. This time, for a change, I've heard that the finance minister has been either conservative or reasonable on the tax collections predictions of the tax collections, which is good. So that's a second interesting thing, that they have very reasonable assumptions have been made in collection of taxes. Of course, something is playing in the mind in terms of third wave, Omicron, whatever it is playing in the mind, I don't know. Or they said that the it is not yet completely played out. The impact of COVID is not completely played out as such. And the new and there is a continuing impetus on the startups and manufacturing, because that's what they like it, and that's what they're continuing to do. Continue to incentivize those in some form or the other. The other point is predictability and certainty. Uh, they brought a lot of changes which are overruling a particular judgment which is not their intention, because it would have been got in a perennial state of litigation, because the law says something, the courts have interpreted something, and then you get into litigation every time. So to just kill that issue up, they have also brought some of the amendments. uh, a couple of amendments have been with retrospective effect, while they have given a detailed intent. There is if you look at the memorandum, which explains a lot of those amendments, the memorandum for this year runs into 200 pages. Keep aside the 100 pages for customs duty changes and the rates changes, but still 100 pages of memorandum is too large enough. And when we read it, it actually has a commentaries, like as if some tax advisor has helped them in typing everything and writing everything. Very interesting. You do not get into a lot of case laws quoted in the memorandum, the reasons quoted. So that memorandum, that's where but after explaining, still the amendments happen with retrospective effect, which is understandable, but still it could have been avoided. The third part was around rationalization. You have some rationalization, they've done some bit tweaking here or there. The most important point is about there are two important sections in the Income Tax Act dealing with not-for-profit and not touching this group. This may not be relevant for them, but there are some tweakings on that. But one thing which has happened in the faceless assessment regime, and there are some important comments in the faceless assessment regime which we'll talk in the course of the detailed presentations. That's all. And then there is on building trust. There is something on avoiding repetitive appeals. Again, it's a minor thing, but nonetheless, hopefully it will help in reducing litigation. With that, I'll request my colleague Jignesh to come and take it over on give more insights on the detailed proposals. Jignesh.
Yeah, thank you, Vikram. Thank you for that. Good afternoon, everyone. With this, I'll start with the tax proposals which have been proposed in the budget. Namrata, go to next slide. Yeah, this is corporate tax rate. As Vikram said, there is no change at all, which is proposed in the budget. So it is same as that was last year. Yeah, this is the amendment relating to portfolio managers in IFSC. Now, what this regulation says is, if you are a portfolio manager in IFSC and if you are managing a non-resident money which is kept in a bank account in India, but a portfolio manager in GIFT City is managing that money and investing that money in offshore market. So, for example, Google or Facebook shares, if you are investing outside India, then any capital gains earned by the non-resident through this transaction will not be taxed in India. And the reason for bringing this amendment was, if the transaction was carried out in this way, the portfolio manager may bring that money in India. So in India, any income received in India will become taxable, and hence this amendment was needed, because on a conceptual level, gift city is considered as outside India. So it is a transaction carried out by a non-resident on a stock exchange outside India. Just because money is routed through gift city, it should not be taxed, and hence by that logic they have brought this amendment here. And hence the opportunity is, if you are managing money, you can set up presence in gift city and start managing offshore money and invest that non-resident money in offshore markets. And few of the AIFs have actually started doing this now. Now, this is at par with AIF, because when AIF is doing, assuming AIF was doing, so what some AIFs have done, they have pulled money from non-residents, and they are doing derivative transaction in offshore markets. Now that is exempt from tax. Here they have said any capital gains is exempt if it is through portfolio management route. So this is also an alternative that is now available. The other amendments relating to GIFT City were one is if you are a if you are a bank or if you are an FPI in GIFT City, and if you are issuing P notes from that GIFT City FPI or from an IBU which is a bank, then the investor who is subscribing to that P notes are not subject to tax in India. Now the logic of getting this amendment was, so consider a case where you are a foreign bank or a FPI who is outside India, maybe in Singapore. They are issuing P notes to the non-resident, and that money comes to India. Now, when Singapore is paying money on that P notes, that money is not taxable. That income is not taxable in the hands of P note holder because that transaction is outside India. Now, to bring GIFT City at par with Singapore or Mauritius, they have done exactly same amendment that if you are paying any money on to the P note holder, that income that the P note holder would be earning is not subject to tax in India. Now, the structure, this structure of P note from GIFT City is little better from Singapore or a Mauritius structure now, is because in a GIFT City there is no concept of beneficial ownership on interest. So today, if a Singapore FPI is investing through in a debt instrument and receiving interest, they need to prove beneficial ownership, and beneficial ownership could be challenged and is challenged by department in some cases, that you are back to back passing on interest to the P note holder. You are not the beneficial owner, we will not give you beneficial treaty rate on interest. Now that beneficial ownership concept is not there in GIFT City, and hence this structure in a GIFT City becomes little more attractive as compared to Singapore or Mauritius. Similarly, you don't have to deal with MLI in GIFT City. GAR will be there, but that in a GIFT City, since GIFT City is promoting tax benefit, one can easily argue that GAR should also not apply. So that is on P notes. The next amendment is relating to ship leasing. Now, if you know, last year budget got amendments for giving incentives for aircraft leasing. Now, this year they have done for ship leasing, and it is exactly in line with last year's amendment for aircraft leasing. Now, what does it say is if you are earning any income by way of interest or royalty on account of lease of ship from GIFT City, that interest or royalty is not subject to tax in India. Similarly, if you are earning any capital gains on transfer of any ships that were leased from a GIFT City, that capital gains is not chargeable to tax in India. The last amendment relating to GIFT City or IFSC is, if you know, today under Income Tax Act there is section 56(2)(7)(b). Now that section says if an Indian company is receiving share premium from a resident in India, and if the Indian company is not able to justify that by way of a valuation, then excess amount over the valuation, excess premium over the valuation which has been collected by the Indian company is subject to tax in the hands of Indian company. Now there was an exemption given to category 1 and category 2 AIFs in India. So if a category 1 or category 2 AIFs are infusing money by way of share capital in the Indian company, then the premium was not taxable even if it was above valuation. They have now amended and said that if this money is invested by a category 1 or a category 2 AIF in IFSC, even that excessive premium will not be subject to tax in the hands of Indian company. Next amendment is relating to virtual digital assets. One first is they have defined virtual digital asset. It just says that it means any information, code, number, or token not being Indian currency or foreign currency. So what they are saying is it will be other than Indian currency, anything which is digital will be considered as virtual digital asset. The tax law says that if anyone is making gains on transfer of virtual digital asset, that gains will be taxed at 30% in the hands of transferor. Now that person will only get cost of acquisition as a deduction. They will not get any other deduction other than cost of acquisition. Similarly, the losses from any other business will not be allowed to be set off against this income, or loss from virtual digital assets will not be allowed to be set off against any other business income. But the losses or gains from earned from VDA can inter alia be set off against each other. The other amendment that they have proposed is, if someone is gifting virtual digital asset to some other person, the recipient of the gift is also taxed as a gift in the hands of the recipient under section 56. The next amendment is, the transferor will have to deduct tax at the rate of 1% on the consideration when they are transferring these VDA assets, when they're transferring the virtual digital assets to the recipient. So there is a withholding tax liability on the transferor. Again, here the way we understand is, in a crypto transaction, uh, we don't know who is the seller and who is the buyer, because that identity is not disclosed, and there is this stock exchange. Similar to stock exchange, there are brokers in between, so you may not know who is the buyer and seller. So it's very unclear as to how will these provisions get attracted. While this section also goes on to say that the CBDT has power to relax withholding tax provision in certain circumstances. So if buyer and seller is not known, they may come out with a circular, as they have come out in stock exchange, in equities case, that there is no need to deduct TDS. Namrata, next. Yeah. The next amendment is, surcharge on any kind of long-term capital gains is now capped at 15%. Earlier, in some cases, that surcharge used to be as high as 37%. They are now capped at 15%, which means if you are transferring a long-term capital, unlisted long-term capital asset, then the tax rate has gone down from 28.5% to around 23.5%. In case of a listed share, in some cases it was as high as 14%, because 10% plus 37% surcharge plus 4% was around 14.3%. That has now gone down to around 12%. The next amendment is, similarly the surcharge for an AOP, that is association of person, is also capped at 15% now. Only if AOP has all their members as companies. Only then it is 15. Otherwise, it continues to be at 37%. The next one is, earlier, if an Indian company was receiving dividend from a foreign company, that dividend was taxed at 15% in the hands of Indian company. Now that has been removed, and it now says you will be taxed at the full rate as the domestic rate. So if a company which has opted for a concessional rate of 25.17%, the dividend received from a foreign company will now be taxed at 25.17%. Now, if that dividend is immediately paid out by the Indian company, you get a deduction under section 80M, which means if you have received 100 rupees from a foreign company and you pay out 100 rupees to the shareholder, then there is no tax on that distribution, or on that the income that you have received from the foreign company. The next amendment is bonus stripping, now made applicable to even securities and other units of pooled investment vehicle. Now this bonus stripping was earlier applicable only on mutual fund units. They have now extended this bonus stripping to shares and even to units of REIT, InvIT and AIF. Bonus stripping earlier was applicable only if the period of holding of the units was 1 year. That still continues. So if the after the record date you are holding that unit for more than 3 years, or if you have purchased 9 months before that record date, only then bonus stripping applies. If it is, in other words, if it is a long term asset, generally bonus stripping would not apply. Next is business expenditure, disallowance. So next is 37(1). This disallowance, this section says if you are incurring any expenditure or a compounding fee, then that fee or that expense is generally not allowed as deduction. Now what happened is many SSEs went and litigated and said this section. Just give me a second. Just give me a second.
Yeah, so I can while Jignesh goes for somebody's come at his home, but uh, on business expenditure, the way the provisions are now worded is that any amount that you pay for not only for violation or prohibition of the law, which was the earlier kind of a provision, but it is now also rules, regulations governing such person's conduct. And while the examples on all freebies to medical practitioners by this, it should be disallowed. The two important aspects to be looked at it, or three, four important aspects. One aspect is that they have extended this to even laws breach outside India. So if you paid anything for breach of law in the country outside India where you're operating, even that expenditure can be disallowed. Two, it is now also looking at it that whether the payment or receipt, both either of them is prohibited by law. So there have been case laws where the pharma companies paid some free samples to medical practitioners, and they said our payment is not prohibited by law, their receipt is prohibited by law. So that is, we are not covered about that. They said now if the either payment or receipt, anything is prohibited by law, it is to be disallowed. And third, it has been extended to what they call as bylaws, regulations, and anything governing person's conduct. Now, very importantly, how does it is relevant to our industry? We also have a NSE code of conduct. We also get into, and the fourth one was for compounding applications. We also get into issues with SEBI on compound and pay and settle that matters by paying compounding fees. Now, those compounding fees not be allowed as a deduction. Even if any issue arises on case of code of conduct and anything you have paid, if it is alleged to be in breach of code of conduct, then that may be, for example, you pay to a distributor of a PMS, right? And tomorrow, if any regulator says this is beyond, this is not in line with the code of conduct that you've done, the market's intermediaries code of conduct, then that could be a challenge. That expenditure maybe disallowed. That's the point that you do take care of it. Yeah,
Yeah,
Jignesh,
yeah.
please.
One more example, just continuing with what Vikram was saying. One more example that I could think of is I have seen many stockbrokers who are paying referral fee outside India, which is linked to the broking income that is earned. Now, generally, this what we understand, this is not allowed as per SEBI regulations. So, if that is happening, that may be disallowed now. Uh, the next is disallowance of health and education cess. So you would know there were few decisions like Rajasthan High Court and Bombay High Court in Sessa Goa, which said that education and health and education cess will be allowed as deduction, and the logic that they had given was there is a difference between tax and cess. Now, tax is something that you are collecting from the taxpayer, but government does not know the end use. They can use that money for any purpose. But if you are collecting some money from the taxpayer for which you know the end use. So in this case, you knew the end use is health and education sector, spending in health and education sector. Now, if you know the end use, that is not tax, that is a fee that you are collecting. Now, based on that logic, and that decision of High Courts were based on some Supreme Court judgment. Now, based on that logic, High Court said that education cess is allowed as deduction. Uh, now the finance minister is saying that this is not allowed as deduction because this is tax, and in their view this was always a tax. That was the intent, and they don't want to give this deduction, and hence they have retrospectively amended this section from AY 56. The next is section 14A, and I'm sure many of the brokers would be facing this disallowance where they have earned exempt income by way of dividend. Now, earlier CBDT had come out with a circular which said that if a person is not earning exempt income but still there are expenses, then there would be disallowance under section 14A. But even after that circular, there are various judgments which said that if there is no exempt income, the expenses also can't be disallowed. Now, what they are proposing to amend and say in the section itself that even if there is no exempt income, there can be a disallowance under section 14A. And again here there is a dichotomy whether this section applies retrospectively or whether it is prospective, because they have inserted a proviso which says that this amendment will always be deemed to be there from the start of the section. That is what they have written. But if we see memorandum says that this section applies from AY 22 from AY 22-23 and onwards. So again the question is, and the litigation which will come up is whether this amendment is retrospective or prospective in nature. The next one is whenever a person makes a interest payment to banks or financial institution, that interest was allowed as deduction only on payment basis under section 43B of the Act. Now, what used to happen is in some cases, the assessees were converting this interest into debentures or into share capital, and there was no actual payment, but that was a constructive payment, and the assessees had taken a stand that they have paid interest because interest is paid and debentures has been issued. Right now, they are specifically saying that this will not be allowed as deduction. The interest will only be allowed as deduction when actual cash flow is happening. Yeah, next is COVID related exemptions. Now there was a press release which was done and by the finance minister in 2021, and that said that any receipt by a person in relation to a COVID expenditure will not be taxed in the hands of employee or a person receiving that benefit. Now they have actually codified it in the law, and what they are saying is if a person has incurred any expenditure for himself or the family member, then any reimbursement which is received from the employer or from any other person is not subject to tax in the hands of a person receiving this payment. Also, if a person has died because of COVID and someone is helping the legal heir or a family member or paying to the legal heir or family member any amount, that amount will not be taxed in the hands of a person. uh, there is no limit when an employer is making payment to an employee, but if some other person is making payment to the legal heir, then there is a limit of 10 lakh rupees. The only change, because when the press release was made, they had said it is exempt. Now they have put one condition under this section that the legal heir should receive this payment within 1 year from the death of the employee. So we have seen many cases where companies have come out with an announcement that an employee has died because of COVID, and they said we will either pay 50% of the salary to family members for 5 years, or we'll sponsor education of the children for till the time they're educated. Now that may become taxable because this section says payment has to be made within 1 year. So that is one thing where employees may have to change their policy. Also, secondly, what is happening is they have said this will be taxable under section 56. Now the question that arises is whether a TDS needs to be deducted under salary section because you are paying to a relative of an employee. Is it because of an employment and hence TDS needs to be deducted? That question is not answered here. Yeah. The next amendment is on TDS on transfer of immovable property. So today, based on current law, uh, a buyer of the property has to deduct tax at the rate of 1% on the consideration of that immovable property if the deal value is above 50 lakh rupees. Now, if you know the on the taxability provision, this was withholding tax provision. On the taxability, the law says that the sales consideration for the seller is either sales consideration or stamp duty value, whichever is higher. So when you calculate capital gains, it is sales consideration or stamp duty value less cost of acquisition, right? So that is the way you compute. Now on the withholding side, that was missing. So what was there was only sales consideration. So now they are saying there also you apply sales consideration or stamp duty value, whichever is higher, and then deduct TDS. So that is the amendment they have brought. Only one thing, if you see on the taxability side, there is a safe harbor which is provided. So if your stamp duty valuation is higher by 10% or 15% in certain cases, depending on your area, then you were not taxed on a stamp duty value, but you were taxed only on sales consideration, right? So there you have to ignore the higher amount of stamp duty if you are within the range. Now, while withholding provisions are introduced, they have not given that safe harbor. So it may so happen that assuming sales consideration is 100, but stamp duty is 100 and stamp duty value is 110, then the taxability will only again be on 100, but withholding will be on 110 because there is no safe harbor provided there. So that is one amendment which has still not been brought in. The next amendment is higher TDS and TCS rate. Now, in the last budget, they had introduced a concept of specified person, and specified person means any person who has not filed return in either of the two immediately preceding previous years. If a person becomes a specified person, which means they have not filed return in any of the two preceding previous years, the TDS rate was double the actual rate or 5%, whichever is higher. So that was the amendment made last year. Now what they are saying is instead of 2 years, we will only see 1 year. So if a person has not filed return for immediately preceding previous year, then the TDS higher rate of TDS will apply here. Yeah. Updated return of income. Now, today the concept is you either file a original return of income or a belated return of income or a revised return of income. Now, the timelines have drastically reduced as compared to past years. Now, the timeline says you have to file your revised return within the assessment year itself. Now that led to a situation where you only get 3 months or 6 months or 7 months at the max to file your revised return. Now, if your form 26AS or some other information gets updated subsequently, you are not able to file a revised return. So they have come up with a concept of updated return where they are saying that you can file an updated return within 2 years from the end of the assessment year if you noticed an error or if you want to rectify something. Now there are few conditions where they have said that you can't do it. So if they have started an assessment or a reassessment, or if they have caught this in search seizure cases, then you can't opt for an updated return. In other cases you can opt for an updated return. Now if you opt for an updated return, then you have to pay taxes, plus there is some additional fees that you have to pay. Now they have said tax plus interest, that fees is defined as tax plus interest. Now if you file an updated return, you have to first pay your tax plus this additional tax, uh, up to 20. So the additional tax is 25% of the tax if you file the updated return within 12 months from the end of the assessment year. But if you file the updated return from 13th month to 24th month, then you have to pay 50% of the additional tax and interest thereon. The next amendment is on litigation management. Now, what it says is See, it says that if any question of law is pending before a jurisdictional high court or before a Supreme Court, and that matter is pending before these courts, and the same question of law is applicable in SSC's case, then department has a choice of whether they want to file an appeal or not in your case. If they say that exactly identical question of law is pending before High Court or Supreme Court, they will so there will be a panel of commissioners who will identify whether this question is identical. If they come to a conclusion this question is identical, they will intimate assessing officer not to file an appeal if the SSC consents to it. So they may come to you asking whether you agree if they are not filing an appeal. If they win the appeal, if the department wins the appeal in High Court or in Supreme Court, they have a right to file the appeal against your case after receiving a positive order from High Court or Supreme Court. And timeline given is 60 days from the date on which they receive the order. So this is like deferring the litigation. So if the exact same case is there, your litigation may be deferred. Now what it helps is there will be the pending cases at High Court and Supreme Court level are very high, so that will come down. But at the same time there are some negative impacts of this also, because if in a normal case, right, if you so take an example where you have got a tribunal order which is favorable. Now department appeals to High Court. In many cases High Court says that we already have given an order on this case and we are not admitting this case. Your matter ends there. Now if you opt for this and you say yeah we are fine, you are not filing an appeal, in such cases your cases, if department wins that appeal in High Court, similar question in Supreme Court, then your case will be filed, they will file an appeal in your case in High Court, so your litigation will keep on going on them. So that is one negative of this scheme. Namrata, next. Okay. Faceless assessment. Earlier they had said that faceless transfer pricing assessment and DRP appeals will also be made enabled before March 31, 22. Now they are saying we have extended the timeline till 31st March 24, and the reason they have given is they want this IT system to settle down, and hence they are giving 2 more years for this IT system to settle down. The other amendment that they've made is they are saying in a faceless assessment today, if a process has not been followed by the assessing officer or by the faceless assessment unit, the section says the assessment is bad in law. Now, what was happening is in many cases faceless assessment or faceless unit had passed an order without giving opportunity of being heard to the SSE or without giving personal hearing to the SSE, or they passed the final order before passing the draft order, and many people filed a writ petition in various High Court. Now High Court sent it back saying the assessing officer has fresh timelines to pass a fresh assessment order. Now this section was saying that the assessment is bad. Now they have specifically said that we are deleting that section. The assessment is not bad, they will get a second chance of passing an order. The next amendment is relating to section 263, where the commissioner had a power to revise the assessment order. Now the section says that commissioner has a power to revise even the transfer pricing orders. Reassessment. So one, they are saying, last year they had amended the section where they said that reassessment is valid if it is on account of audit objection. So if the auditor has raised an objection, there were various judgments which said that reassessment is not valid. So last year they amended the section that if an information is received because of audit objection, reassessment is valid. Now they have expanded that to say that if they have received any information under exchange of information agreement under any treaties, tax treaties, or from any tribunal or a court order, then they can still do a reassessment. So that is what they have amended. The second amendment that they have done is last year they had amended the timeline for reassessment and increased it to 10 years if the income escaping assessment is more than 50 lakhs and income escaping assessment is represented by form of an in the form of an asset. So that was the amendment. The question which arises is, will the reassessment be initiated only in case of an income represented by form of an asset, or will reassessment be initiated even when an expenditure is wrongly claimed? And that's where they have now amended the section, and they have said that if there is an expenditure relating to a transaction or event or occasion, or if there is an entry in the books of accounts, then we can reopen that case for a period of 10 years. The next amendment is there were few prior approvals required before reopening an assessments, like approval of commissioner if the amount of income assessed is more than some limit, or a joint commissioner if it is between some limits. So they have waived off that, and they are saying even if that approvals are not taken, then reassessment is bad in certain cases. Yeah, this were the amendment. If there are any questions, happy to take questions.
Yeah, Mahesh bhai, the questions participants can ask, how can they ask me? They can put on chat box, or that's done with the session. How you want to handle?
Vikram, they just wrote there are no questions on the chat.
Okay, okay.
Right, Vikram bhai, thanks for giving this full presentation, detailed overview by the Vikram bhai related to budget, and the Jignesh has given the total taxation details. Thank you very much, sir.
Thank you.
Okay, thank you for the opportunity. Thank you very much.